So what we'll do today is we'll finish up the chapter 10 fake quiz. And then also, since we're a little bit ahead, I want to start the next chapter, which is chapter 11. According to the schedule, we're not scheduled to start chapter 11 until next week, but I'd like to start it today so that we are efficient and use the opportunity to continue to go over new material. That probably means that we will be able to finish class a little bit early today. So I know everybody has a life outside of accounting and is probably eager to start their weekend. So this is, I think good for everybody. We'll finish up chapter 10, fake quiz. We'll do an overview of chapter 11, which is responsibility accounting. And then hopefully we can leave a little bit early. Okay, so that's going to be the plan. Before I forget, I want to remind all of you that the chapter 10 graded assignment is due on Connect. Okay, and then it's already posted. And I think maybe 40% of the class has already started it. So if you haven't started it, make sure you do it this weekend. As always, there's a lot of resources online for you on Connect, and only the graded assignment is going to be due. Okay, so with that being said, does anybody have any questions or comments as we get started? Okay, all right, let's take a look at the fake quiz. So I know we did the first question, okay, but let's just redo the whole thing from the very beginning. This is a good opportunity to review a little bit about variance analysis. Okay, so variance analysis, we said, is like peeling the layers of a skin of an onion. That means that you have a difference between budget and actual, right? So this difference between budget and actual is called the total variance. Okay? But you can take the total variance and you can break it into smaller pieces, right? So you can have the total variance, and the total variance is made up of two ingredients: price, or sometimes people call it rate variance. And there's also what's called quantity, or sometimes called efficiency variance. Okay? So in this chapter, we talked about identifying variances, in particular, identifying the price, quantity, and total variances, 3 variances. In order to do that, we can use this very helpful formula that we learned in class. And frankly, this is the only formula that you need to know for this chapter. Okay, and the formula looks like the following: AQ times AP, AQSP, and SQSP, right? So this is the last formula, the only formula, and the most important formula that you need to know for chapter 10. Now, who can remind me what variance goes here? Okay, so we have a variance here and here. We have a variance. Okay, so what I mean is, what is the variance between the first and the second number? That's called the price variance, right? So we call that the price variance. Okay. The variance between the second number and the third number, okay, is called the quantity variance. Okay, quantity variance. And then, of course, the variance for the whole thing is what we call the total variance. Okay. Okay. And we can also put some arrows. I think arrows look a little bit nicer, so let me do that. And then we can always use this relationship when we do problems from this particular chapter. So we have the variance between here and here. We have the variance between here and here. And then we have the total variance. The total variance is the difference between the first variance, or the first number, and the last number. Okay, good. Anybody have any questions on that? Okay, let's take a look at these questions together. So for number 1, it says the direct material quantity variance standard. Okay, so direct material quantity. So what type of stuff do you use when you are buying or using direct materials? Well, we said pounds, like pounds of flour, right? Barrels of oil. Those all sound like materials that you can use. Board feet of like lumber, right? Dollars would be the answer here. And that's where we left off last time. Okay, anybody want to read number 2? Anybody? I know it's Friday, but Molly, okay. Yes, Molly, read number 2.
The direct labor quantity standard is sometimes called the direct labor.
Quantity is also called, what is quantity?
Efficiency, I guess. Efficiency standard.
Yeah, efficiency. Quantity, efficiency, or price is also called what? Price is also called rate.
Rate.
Rate, good. Okay, excellent. Okay. All right, how about number 3? Would anybody like to read number 3? Anybody want to volunteer? Okay. I was going to make a joke and say not everybody at one time. Okay. Okay. Oh, somebody raised their hand. Okay, Levi, yes, please. Number 3.
A manufacturing company would include setup and downtime in their direct.
So setup.
I think it's the labor quantity standard.
Yeah, very good. I think so too. Okay, so setup time is like the time you use to, maybe clean up the kitchen if you're going to make cookies, or take out the dishes, or like the utensils you're going to use, or pots and pans. That's setup. Downtime is like waiting for cookies to bake. That all sounds like direct labor quantity standard. Direct labor quantity is about hours, right? So this is about hours of time, right? The rest doesn't make any sense, right? Materials quantity, like that doesn't include setup or downtime. That includes like flour or sugar or ingredients you use, right? So number 3 is D. Okay, excellent. All right, anybody have any questions on number 3? I have a question. Number 4. Anybody want to read number 4? How about Lily? Can you read number 4?
Yeah, number 4 says an unfavorable material quantity variance would occur if.
So what would how could we have an unfavorable material quantity variance? In other words, like you're baking cookies and you used more chocolate chips than you expected. What would be the best answer, you think? You used more materials.
Well, then wouldn't you need to use more materials like surrounding that one to make it more even?
Okay. So would it be B or D? What do you think?
Let me read it. D.
Good, very good. It's D. Okay. A is not the correct answer because it says you purchased more than you used. So, I mean, maybe you purchased more than you used. That means you have some extra materials left. That has nothing to do with a variance. A variance is about actually doing something, right? A variance means like I actually used more materials than I was supposed to use. That causes a variance, right? So materials quantity variance, you used more flour, butter, or materials than you expected to use or you were supposed to use. That's exactly what D is saying. Okay. All right, I'll read number 5. It says, if actual materials costs are greater than standard material costs, it means that, okay, so what happens if your actual costs are more than what you expect? That's what they're saying. A says actual costs were calculated incorrectly. I mean, maybe, but that doesn't necessarily mean that, right? We're looking for the best answer. How about B? the actual price of direct materials was greater than the standard unit price of materials? Could be. I mean, I don't know. That sounds okay, but I better read all the answer choices. It says the actual unit price of raw materials or the actual quantity of raw materials used was greater than the standard unit price or standard quantity of raw materials expected. Wow, that sounds like an awesome answer. In other words, number 5 is saying if your actual cost is bigger than what you expected, C is saying, well, maybe because the actual price you paid or the amount you used is more than what you expected to pay or expected to use. C sounds like it's a really, really good answer. D says the purchasing agent or production foreman is inefficient. I mean, maybe, maybe not, right? The best answer is definitely C. B is okay as an answer. That's partly correct, but the best answer that explains all the possibilities why you're actually spending more money than you thought you would is definitely answer C. Okay, so the answers are C, C, D, D, C. Okay, so A and B were not answer choices anywhere here. But does anybody have any questions about 1 through 5? Okay. All right, let's do the last problem. So this is the last problem in this chapter, and this was from an old exam I gave. Okay, so back before the pandemic, when we had exams like in person, in class, I used this as an example question. Okay, or an actual question on the exam. Okay. All right, let's take a look at this question. It says, Riggins Inc. manufactures one product called Tybos. Okay, all right. The company uses a standard cost system and sells each Tybo for $8. All right. At the start of monthly production, Riggins estimated 9,500 Tybos would be produced in March. Okay, that's what they think is going to happen, right? Riggins established the following material and labor standards to produce one Tybo. So these are standard information, like standard price, standard quantity, that type of stuff. It says, during March 2019, the following activity was recorded by the company relating to the production of Tybos. Okay, this is what actually happened, right? It says the following was recorded, meaning that it actually happened. We actually recorded the following. So what did we actually do? We actually produced 9,000 units, okay? It says we purchased 24,000 pounds and actually paid $66,000 for those pounds. And by the way, we actually used 24,000 pounds, okay? So you bought 24,000 pounds, you actually used 24,000 pounds. You actually paid $66,000. 5,000 hours of labor were incurred. That's how many hours of labor you actually had, right? And you actually paid labor cost of 55,000, right? Okay. All right, so let's take a look at the materials variances first, because we're going to have to do this twice. One time for materials and then one time for labor costs. The first thing you should ask yourself before you do anything else is figure out, what are they actually talking about, right? How many units do they actually make? It says here 9,000, see? We actually made 9,000 units. So how much is it supposed to cost to make 9,000 units? So 9,000 units. Okay, so this is the cost object that we're going to use in our analysis. Okay. What they actually did. They try to trick you in this problem here because they say, oh, I think I'm going to make 9,500 units. Yeah, well, that's not exactly what you did. You actually made 9,000 units. So if you actually made 9,000 units, how much did you actually spend? How much are you supposed to spend, right? If you think you're going to do something, that doesn't mean anything in accounting, unfortunately, right? I think I'm gonna hire a president at $100,000 a year salary. Yeah, but you didn't actually do it. You know, thinking about something is one thing, but in accounting, we're worried about what actually happened. Okay, so actually. So let's type in this part here. Somebody in the other class told me that this chapter is very therapeutic because it's very visual. You know, you get to make a lot of lines if you do it on like a piece of paper. So I was interested that they said that because that sounded interesting. Okay, the good news about problems like this is all the information is somewhere in here. We just have to figure out what information goes where. Okay, how many, we're doing materials, right? How many pounds of materials did they actually use? Actually. It says here 24,000 pounds were actually used, right? Okay, good, very good, Madison, 24,000. Okay. So this means on the test, everybody will be an expert on this problem. So that's good. I'm excited to see that on the test. Everybody gets this perfect, correct on the exam. Okay, how much did they actually pay per pound? Some people are tempted to put 66,000, right? That sounds like expensive material. I don't think that's really that's not the actual price per pound. I think that's the price for the whole thing, right? I want to say something here. If you try to put 66,000, it's wrong. Because what's the standard price per pound? It's $3, see? So if standard price is $3, standard price, if standard price is $3, then how can the actual price per pound be $66,000? That makes absolutely no sense, right? So 66,000 has to be the total. So it has to be the total. Okay. Okay, so the actual price, we can do some algebra, and in the chat, we have Molly and Junfei, $2.75. Very good. 275. 275. Okay. Always do the corner, like when you do a puzzle, you always do the corners, do the left side, do the right side, then do the middle, right? Always be careful of standard quantity because that one is the trickiest. Okay, it says here, we're supposed to use 2.5 pounds for each unit, right? If you make 9,000 units, how many pounds are you supposed to use? That's 9,000 times 2.5, right? 9,000 times 2.5. Okay, this is the standard quantity. Because to make 9,000 units, we actually used 24,000 pounds. So to make 9,000 units, how many pounds are you supposed to use? That's 9,000 times 2.5. And the standard price is 3. Okay. Okay, we can do the middle part now. Okay, so the middle part is actual quantity, which we have here. It's 24,000. Times standard price is 3. Okay. So standard price is 3. Okay. Okay, so let's figure out what goes in the middle and at the end here. So 24,000 times 3 is 72,000. Okay. Okay, good. And then how about up at the end here? Okay, I'll let you do it. I'm gonna put my calculator down. What do you have at the end? 67.5. Okay, thank you. 67,500. Okay. Okay, good. All right, then comes my favorite part. The first number. Okay, so the first number and the middle number. We're going to figure out the variance. All right, so we'll figure out the variance here. And then we'll figure out the variance between the second number and the third number. Okay. All right, and then we'll do this one more time and we'll figure out the variance between the first number and the third number. It's the first number and the third number. Okay. Okay, and then again, always go from left to right. Always, like when you read something, you read left to right. When you do the math, always do it left to right. 66,000 minus 72,000 is, okay, it is 6,000 F. Okay, thank you. 6,000 F. Oh, I better put price variance. Don't forget to label it 6,000 F. Okay. How about here for the quantity variance? 4,500 U. Okay. And last but not least is the total variance. Okay, and I'll rely on people to help me with that. What's that going to be? Take 66,000 minus 67.5, 1,500 F. Very good. 1,500 F. Okay. Okay, anybody have any questions on this? Okay, let's do this one last time, and then we'll call it quits on this chapter and move on to the next one. Okay. Okay, so if we make 9,000 units, what are the labor variances? Labor variances. So of course, the setup is always the same. So here it is. Labor variances. Okay. Okay. How many hours of labor did you actually use? By the way, actual is also called incurred. Okay, good. Levi and Molly, 5,000. 5,000. Okay. Times. How much did you pay per hour? I don't think it's 55,000. That would be awesome. I would probably quit my job at AU and take that job if it were 55,000. I bet you 55,000 is the total, right? So then we have to do some math to get the AP actual price, which is, okay, good, Molly. So 55,000 divided by 5,000 is 11. 11. Okay. Okay, let's do it again on this right side here. What's the SQ? Be careful. This one is always the one that's you have to do a little bit more math on, right? Means if I make 9,000 units, how many hours of labor am I supposed to use? If I make 9,000 units, how many hours am I supposed to use? 9,000 times 0.6. Okay, is that okay for everybody? 9,000 times 0.6. Right. Okay, good. Times how much are you supposed to pay for each hour of labor? Supposed to pay standard price 10. Okay. So what do you get on this right side here? $54,000. Good, 54,000. Okay. 54,000. Okay, anybody have any questions about any of this so far? Like, can you repeat this? How did you get that? Okay, let's do the middle part. AQ is 5,000, right? 5,000. Okay, times SP is 10, right? So in the middle, we get 50,000. Okay. So in the middle, we get 50,000. Okay, so we have all of these numbers. We can figure out the variance between the first and the second number. Okay. We can figure out the variance between the second and the third number. Okay. And then we can figure out the variance between the first number and the last number. Okay. Okay. Okay, so this is called the price variance, or some people call it the rate variance. And this is 5,000, positive number. So we say U. Here we have the quantity variance, sometimes called efficiency variance. You take your pick. This is a negative number. Don't ever put a negative sign. Always put the number. 5,000 minus 54,000 is 4,000. Negative means less. Less cost is favorable. I like less cost. Right? Total variance is 55,000 minus 54,000. It's a positive number, so it's 1,000. No need to put the plus. Somebody in the other class put plus. Just put the number. If it's positive, it's unfavorable. Positive means more cost. More cost is not good. Okay. Okay. All right, that's the answer. Okay, good. Anybody have any questions on this? No questions? Okay. Let me give you a few more seconds to copy this down. I think some people are still copying this down, so I'll wait. Oh, I wanted to tell you something. I have a nephew who is 10 years old, and he's in elementary school, and he takes like some classes online, and they have to have 2 cameras. So they have to have one camera, like, so the teacher can see your face. And then they have to have another camera, like looking down, so the teacher can see what you write. So I thought that was kind of interesting. And then I was thinking to our class where you don't have to turn your camera on because you're adults, and they make it optional, right? I guess some professors force you to turn your camera on, but do you have any professors that do that, like tell you you have to turn your camera on? Anybody have that experience? Nobody? Okay. Yeah, everybody's an adult, so if you want to, you can. If you don't want to, you don't have to. Yeah, okay. All right, good. All right, so last semester I had one teacher that made everybody turn it on. Okay, yeah, I think professors can do that. That's actually kind of a gray area in my opinion, because I don't know, some people would say it's a privacy issue, like but then you could like blur your background. So is it a privacy issue? Some professors record the session, so if you have your camera on, people see your face. Is that a privacy issue? I have no idea. So I guess you could make an argument for either way. Okay. How many people like chapter 10? I like it. Okay. So only like 1, 2, 3, 4, 5, 6 people like it. Everybody else hated it. 7 people like it. Okay, so maybe everybody else thinks it's meh. Okay. Okay. Anybody have any other questions about the chapter? Okay, let's move on to the next chapter then. Okay. All right, so my goal is to try and get you out of here early and you can start your weekend. But I do want to introduce chapter 11 because this is for next week. But since we have some time, let's go over it a little bit today. Okay, so chapter 11 is responsibility accounting. Okay. So chapter 11, a lot of it is very conceptual. Okay, so in chapter 11, basically, it starts based on this premise. Okay, a lot of companies are decentralized to some extent. Okay, so when people think of centralized organizations or decentralized, really the way that you can think about it among other ways, is to think about how communication and authority flows, right? So with a centralized organization, it's very hierarchical, right? So think about the military. The military is very centralized. So you have like somebody at the top and they give orders to somebody at the bottom, right? So with communication and orders and commands, if something is centralized, the communication flows downwards, right? With decentralization, it's flat. So that means that people can communicate with one another, right? And which is better, centralized or decentralized? Really, it depends, right? So if you are trying to run a nuclear power plant, probably centralized authority and responsibility makes sense, right? Because in a nuclear power plant, you're not trying to be innovative or creative. You're just trying to like make sure that something gets done a certain way, right? For companies like Tesla or companies like Apple, where you want to have like more feedback and you want to be innovative and you want to be creative, then decentralization tends to make more sense. Right? So think about centralized or decentralized. And the truth is no organization is 100% one way or the other. Every organization has some components of centralization and maybe some components of decentralization. But there really is a tendency to either be more centralized as opposed to less decentralized or vice versa. So in this chapter, they talk about this idea of decentralization, right? That means communication and authority levels are relatively flat. That means that decisions are made by the boss, but also people at a lower level can also make decisions as well. Does anybody have any examples of working for a decentralized organization? Like maybe you worked at a pizza place or an ice cream shop or anything like that. Was it centralized or decentralized? Maybe people can share their experiences. You can either raise your hand and tell us or type in the chat if you like. Anybody have any thoughts? In the other class, people said, I've never even had a job before, so I don't have any experience. Okay. Okay. How about in this class? Okay. In the chat, we have decentralized. Okay. Levi, where did you work or what were you involved in? Can you share with us?
I didn't actually work before. I just thought it should be decentralized.
Okay, so you have you tend to think that decentralized organization structure works oftentimes very well. Okay, that's good. Fair enough. How about Madison? Madison, have you ever had a part-time job, or if you did, was it centralized or decentralized in terms of responsibility?
I have not, but I worked at a company last year and it was kind of a combination because like some of the lower level employees were allowed to make decisions, but they had to be approved by some of the upper level employees.
Okay, good. I would say as a professor, my personal experience, my job is very decentralized, right? So it's not like the president of the university tells me like, you know, you have to teach chapter 11 today, you know, that type of thing. So it tends to be more decentralized, at least from my experience as a professor. In the chat, we have, okay, so we have one person who served in the military. Yeah, that's very centralized. Yeah, my father was in the military too. It's very, sometimes it can be annoying because he thinks he's like the big boss and then he orders everybody to do stuff. So, but that's, you know, not to say that's always a bad thing. It can be good or bad depending on the situation. In particular, when we talk about decentralization, because that's going to be the focus of this chapter, decentralization is one approach to responsibility within an organization. And we can talk about it conceptually and also from an accounting perspective. So conceptually, decentralization makes sense. It's a good thing to have because lower level decisions can be based on better information. So somebody at a unit level or at a lower level typically has more recent or more hands-on information, and so they can make better decisions, right? So if I run an ice cream shop and then the employees who work at the shop, you know, maybe they might give somebody a refund or something. They know exactly what situation happened. You know, maybe a customer was unhappy or their ice cream, you know, didn't taste right or something. They are in the best position to make lower level decisions, right? Because they have more recent, current, and oftentimes better information. Another benefit of decentralization is the fact that you allow people to make decisions on their own, so they gain experience, right? If somebody at a lower level of an organization is always told what to do, then they typically tend not to think in terms of what the best option is going to be. They just do whatever they're told. Right? If you allow lower level managers to make decisions, you're essentially delegating authority, and that allows top management to focus more on bigger picture things like strategy. Look at this next one here. If lower level managers are allowed to make decisions and offer refunds or give customer credit on something, if they're not happy with their purchase, then you can more quickly respond to the market and particularly to customers. And finally, if you allow people to make decisions, then they tend to feel like they're more trusted, and that tends to lead to better job satisfaction. Now, decentralization is not always a good thing, because decentralization may lead to a lack of coordination, right? Because everybody is doing their own thing, and so they may not think of the big picture. And that's the second point here, lack of goal congruence. Okay? So goal congruence means I'm responsible for division A, somebody else is responsible for division B, and I'm only worried about the profits in division A because that's my division, right? And somebody else is only worried about the profits in their division. So in that case, we aren't necessarily trying to promote the overall goals of the organization. That's called a lack of goal congruence. I would say that this is one of the biggest problems with decentralization, is everybody just tries to do their own thing. Right? And that's a very common problem within organizations. So maybe Kogod School of Business wants to raise money for their school, but they don't worry about, you know, raising money for other departments or schools at American University. Obviously, that's not really good thinking for the entire university as a whole. Something that's related to lack of goal congruence is this notion of siloed thinking. Siloed thinking means I only worry about what's happening in my department. I only worry about what's happening in my responsibility center, and I don't care about what's happening anywhere else. The final problem with decentralization is that if there's innovation or best practice or a better way of doing something, maybe it's only done in this department, but not anywhere else, right? So with decentralization, you have issues where somebody might be doing something in an efficient way, but other departments don't know about it. Okay, so we're going to spend this chapter going over accounting and how accounting can help to mitigate these disadvantages of decentralization. In particular, this lack of goal congruence. This is really, of all of the disadvantages within a decentralized system, this is really the most pervasive and the one that actually leads to all of the other disadvantages. Because if everybody only worries about themselves, then of course there's going to be lack of coordination, because I only care about what I'm doing. I don't care about organizing with other people. Maybe I will organize with other people if it's good for me, but otherwise I don't want to do that. If I have lack of goal congruence, if I only worry about myself, then of course I'm only going to think about what's good for myself. That's siloed thinking. If I'm only worried about myself, then of course, if I do something better than everybody else, if I have like a better system, then yeah, maybe if you ask me, or maybe if I feel like it, I might share what I know with you, but it's not my priority to do that because I'm only worried about my department, right? So it's kind of like this notion that, you know, if everybody looks out for their best interest, sometimes it's not really looking after the whole interest of the organization, right? So the question in this chapter really is how can we implement a decentralized system so that we promote greater good or goal congruence. Okay. So that's what we're going to be focusing on in this chapter. Okay, does anybody have any questions about this so far? Okay, let's talk about responsibility center. Responsibility center means what am I responsible for? Okay. If you are a profit center, you are responsible for revenue, you're responsible for bringing in money, and you're responsible for costs. You're responsible for bringing in money, and you're responsible for what you spend your money on. That's called a profit center. Revenue center means you're only responsible for bringing in revenue. That one is maybe a little bit harder to understand, but think of maybe like a sales department. So a sales department, they are responsible for selling the product, and then that's all they have to worry about. That means that they're a revenue center. They're only responsible for bringing money in. My mother told me that when I was younger, my sister and I, we were cost centers. We only care about costs, right? Our job is only to spend money. That's a cost center, right? I would say being a cost center a lot of times is really a fun thing to be because you don't have to worry about bringing money in. You only worry about spending money. So I would say a cost center would be like a promotions department. So for example, within an organization like a casino, casinos have like promotions departments. They're responsible for like giving out comps to people, giving out free meals, or giving out, having like I don't know, some type of event, and then giving out free stuff at the events. That's a cost center. You're only responsible for your costs. Investment center is where you are responsible for revenues, costs, and your investments. So for example, with an investment center, I'm responsible for bringing money in, like making sales. I'm responsible for the money that I spend, my costs. And I'm responsible for investing the extra money I have. Like, am I going to buy a new building? Am I going to invest in new machinery? That's an investment center. Okay. Good. Anybody have any questions on this? Responsibility accounting? Okay. Okay, let's talk about how you can evaluate a responsibility center. So if I'm division A and Madison is division B and Jackie is division C and John is division D, how do you evaluate how well each division performs? Right? We can use what's called the DuPont equation and return on investment. Has anybody heard of the DuPont equation? Maybe in finance. Anybody? Okay, nobody? Okay, so every division or every business operates as follows. Every business has cash, right? And then you use cash to buy inventory. That makes sense. And then when you sell inventory, you have sales revenue. And then if somebody owes you money, you have an account receivable. So let me draw some arrows here. Every company has cash. They use their cash to buy inventory. Okay. They sell their inventory and they have revenue. Once you have revenue, if somebody hasn't paid you yet, you have an account receivable. And then finally, when they pay you, you have cash again, right? So every company operates on this theory that money is like a wheel, profit wheel, right? So every company starts with money. They buy like hot dogs. They sell the hot dogs and customers owe you some money, which you eventually get back in cash, right? Can you tell me if I start with $1 here and I turn the wheel one time, how much money will I have at the end? If I start with $1 here, if I turn the wheel one time, would I have $1 at the end or less than $1? What do you think? Does anybody have any idea? Obviously more than $1, yeah, because why would you be in business if you're gonna have $1 in cash and then make a sale and then only have $1 after that, right? Okay, so let's take a look at how we can make a lot of money. Okay. Oh, AR is account receivable. AR is account receivable. Okay, so how do you make a lot of money? If every company operates on this theory, how do you make a lot of money? I'll give you a moment to think about that. Okay, so think about that, and then maybe in the chat, type how a company can make a lot of money. Okay, anybody have any ideas how you would make a lot, how do you make a lot of money if every company operates based on this principle or every division? Anybody have any ideas? Molly, what do you think?
Yeah, I think this 2-point equation might be help to controlling the expenses, like,
Mhm.
and then because since you're controlling your expenses, that might be increase your profit. So you know, like what you need to do, like how much you need to pay for this and how much you need to pay for that, I think.
Good, very good. So in other words, if I control my expenses, then if I have $1 or $100 in cash, then I'll buy inventory, I'll sell it, and then I'll have a lot of money after I turn the wheel one time. In other words, I think what Molly is saying, one way to make a lot of money if you use this DuPont equation is every time I turn the wheel, I get a lot of money out, right? That's called profit margin. Does that make sense, everybody? So one way to make a lot of money is you turn the wheel one time and a lot of money comes out. So that's called profit margin. Okay. Is there any other way to make a lot of money? I think so. I mean, you can like turn the wheel one time and a lot of money comes out. Or anybody have another idea? How about you turn the wheel off a lot of times, right? You turn the wheel fast, turn the wheel often, faster. If you turn the wheel faster, anybody know what that's called? It's called turnover, turnover, turnover. Okay. Okay, so 2 ways to make a lot of money is every time you turn the wheel, you get a lot of profit, or you just spin the wheel very quickly. Right? Profit margin is net operating income, like how much profit you make compared to how much you sell. Okay. And then turnover. Turnover is how fast you turn the wheel. So how fast you turn the wheel, that's a formula 2. That is sales revenue over that's sales revenue over average operating assets. Okay, so let's take a look at these formulas here. Profit margin. Let's say I have $100 in sales, and then I have very low expenses. So I have $99 in operating income. That's very good profit margin, right? That means I turn the wheel one time and I make a lot of profit, right? Sales revenue divided by average operating assets means how fast you turn the wheel, right? I have $100 in assets, but I'm making $1 million in sales. I must be like using my assets or my money-making machine very quickly or turning the wheel very fast so that I can generate that type of profit. Okay, so companies or divisions make money by either having high profit margin, you turn the wheel once and a lot of profit comes out, or you turn the wheel very quickly and then you do a lot of business that way. It's very hard to do both, actually. Usually there's a inverse relationship. If your margin is high, usually you don't sell as much, so your turnover is low. If your profit margins are low, then people, want to purchase your product because, hey, it's a good product. The company isn't making a lot of profit, so probably the price is very good. Then the turnover tends to be higher. Can you give me an example of a company that makes money based on profit margin? Maybe they don't sell a lot of products, but when they do sell a product, like 1 unit, they make a lot of money. Can you give me an example of a company that uses primarily a profit margin driven approach? I have one example, Boeing, right? If Boeing sells one like 777, 800 series airplane, it's hundreds of millions of dollars. So on 1 unit, they make a lot of profit, right? Designer companies, very good. Yeah, like a Louis Vuitton bag. One bag is, I don't know, like thousands of dollars. And when they sell 1 unit, they make a lot of profit on that 1 unit. Lamborghini, absolutely. It's another good example. Okay. Can you give me an example of a company that utilizes a turnover-based approach to profit or making money? In other words, they rely on just selling lots and lots of units. Okay, McDonald's, right? That would be an example. Can you think of something else? Shine. Okay, I've never heard of that, but that could be an example. Oh, okay, it's a clothing brand. Okay, so maybe it's like cheap clothing. Okay, so they make their money by just selling a lot of clothing. Okay, all right. Any other examples of companies that use a turnover-based approach? Maybe Costco. Costco. So Costco, they don't make a lot of money on their products, but they just rely on selling a lot of the products that they have. Okay, is this okay for everybody? We're going to go over it again next week. I just want to introduce the idea today. Okay, let's talk about two last things, and I promised I'd let you leave early. Okay, so residual income is another way to evaluate how well a division is doing. Okay, so residual income means how much money did you make? Okay, I made $100. Okay. And how much assets did you have? Like what's your engine, or what do you have to work with? Well, I have $5,000 worth of assets, and I need to make at least 10% return. Let's pretend minimum rate of return, 10%. Okay. In this case, let's make this 1,000 so the number's positive. Okay. In this case, the answer would be $500. In other words, residual income means how much extra are you making? In other words, net income, you made $1,000, but this part here, this is like the minimum I'm expecting, right? You have $5,000 of money, you have $5,000 of assets, and you have to make at least 10% return, right, on what you have. You're working with $5,000 worth of assets, and I expect at least a 10% return. That means if you make $1,000 minus, if you do the math here, it's $500. That means that you're making $500 more than the minimum that I expected, right? So residual income actually means actual amount made minus like the minimum I expect. The minimum you expect is based on your operating assets times like the minimum rate of return, like the percent that you expect. Okay, can you give me a thumbs up if that makes sense, residual income? As a theory, we're going to do lots of problems next time. Okay, only makes sense to one person? Three, okay, three, okay, four, okay, good. Okay. The last thing in this chapter is transfer pricing. That means selling to divisions in the same company, okay? Or I have a better analogy for you. Transfer pricing is about selling to people in your own family, okay? Let me explain what that means. Okay. Well, let's pretend let's see, we'll use Lily as an example. Lily, let's pretend that you are a accountant. I have no idea what you're going to major in, but let's pretend you're an accountant. How much do you charge other people to do taxes? Just give me any number.
Let's go with $2,000.
$2,000. Okay. Let's pretend, Lily, that we're siblings. Like I'm your brother. We're the same family. I need you to do my taxes. Would you do it for free, or would you charge me if I'm your brother?
I'll be nice. I'll do it for free or at a reduced cost.
Okay, see that exactly the point. If you do it for free, then you're very, very nice, but maybe that's not really fair for you because you have to spend some of your time. I don't think it's fair to me if I pay $2,000, your normal price, because we're family. So maybe we can come to some kind of like reduced rate, so that I'm getting a deal and then you're not getting taken advantage of. Right? That's transfer pricing. Okay? So transfer pricing is this idea of when you do business within the same company, like two divisions in the same company, or two people in the same family. If you're going to come to some financial arrangement, you don't want to have an arrangement where the person is paying the normal rate, because then they could just buy it, from somebody else outside the family. You don't want to give it away for free, because that's not fair to the person selling the product. you want to come to some kind of like negotiated price that's in between so that everybody is happy, right? That's what we call transfer pricing. We'll talk about next time that the rule for transfer pricing is variable cost plus opportunity cost, right? And when it comes to transfer pricing, who sets the maximum? Do you think the buyer or the seller sets the maximum? The buyer. That makes sense, right? If you're a buyer, you say, I'm not going to pay more than $1,200 for something, right? So the maximum is set by the buyer. Who sets the minimum? Like the absolute lowest price that will be accepted? That's the seller. I'm not going to sell for anything under $800, right? Everything else in the middle is the transfer price range. That's what we have to negotiate and figure out. Okay. Have you ever sold anything to your family? And if so, did you give them a discount? Have you ever had a financial transaction with your family? And if so, did you give them a discount? Madison, what do you think? Did you ever like sell something to your family, or did they ever sell you something? And how did you arrive at a price, transfer price?
I've had family members definitely give me something at like less of a cost, but I'm not really sure how they determine that pricing
Mhm.
because I didn't really like have anything to do with it.
Okay, but it was definitely like not the market price. It was like somewhere like kind of less than what you normally would pay outside of the family, but it, you know, it wasn't for free either.
Yeah, no,
Okay.
yeah, for sure.
Okay, that's what we call transfer pricing. Okay, and that's what we'll talk about next time in class. And we'll do some transfer pricing problems to see exactly how transfer pricing works. Okay, okay, questions, everybody? Anybody have any questions, comments about anything? Okay, all right. Okay, then I think that's enough for today. I'll stick